Thank you for being here again today. Several years ago, a young middle-aged family man left his home early en route to his regular basketball game. He arrived as usual at the gym early. He laced up, he warmed up, and as he'd done 1,000 times before, he started on down the basketball court. He would never make it to the other end. The doctor's diagnosis was massive heart failure. A few days following the funeral, grief grew into fear as emotional devastation escalated into economic alarm. Reality was settling in. Not only had a wife lost her husband, 4 younger children their father, but the household would be left without any income. Fortunately, those panic-filled days and undoubtedly sleepless nights would be short-lived as a phone call was placed, and a benefits rep at DMBA informed this young mother, recent widow, that just months before he had passed away, that good man had signed up for supplemental life insurance. Now, I'd like to tell you about the 2 events that made this outcome possible. By the way, if you're a financial planner and you sit down with a recent widow, this is about the happiest ending to a story that starts with, "I just lost my husband," that you could hope for. The first event took place 104 years ago, when in 1912, Montgomery Ward and Company, anyone old enough to remember that establishment, used to order off the catalogs at Christmas. Montgomery Ward in 1912 approached the Equitable Life Assurance Society of New York and asked them for help in providing coverage for all 2,912 of their employees. An agreement was reached, $5,965,000 in insurance was extended, and the first large-scale employer-sponsored life insurance program was born. Now, the outcome to the story I told you could have been much different if it hadn't been for a second event that took place just several years ago. This father of 4 sat down with one of our very own certified financial planners in a routine meeting. And I can imagine the conversation going something like this: "Brother, you're underinsured. All you have is the $50,000 in basic benefits that you were extended when you were hired." And the father perhaps responding like this: "Well, but I'm young. I eat right and I'm active. I play basketball 3 times a week." Nevertheless, would have persisted the planner, "You never know. And for a few premium dollars a month, you owe it to your family to make sure that if the Lord does call you home early, the ship doesn't sink for the family you've left behind." Now that good planner, as is his custom, didn't stop there. He, on the spot, would have enrolled that good man in the supplemental life insurance program. Neither of them could have known that just a few months later, less than a year, his family would be paying the mortgage and buying groceries with the very policy, the proceeds from the very policy he had just applied for. Now, the story that I just told you is not meant to startle you into running out and buying a bunch of life insurance. In fact, many of you may already be appropriately covered. In fact, most early deaths do not occur in the United States. In this country, the Social Security Administration estimates that for a young male born in 1993, a soon-to-be alive at age 20 and to never been disabled, only runs an 8.5% chance of dying before full retirement age. For an otherwise healthy woman, that risk is reduced to 4.4%. But it is not the probability of death that drives the need for insurance. It's the potential economic impact of just such an event that should drive your decision to buy insurance. Now, the Bureau of Labor Statistics suggests that today, since that landmark event in 1912, almost every employee for middle and large employers in this country, That's companies that have at least 100 employees have access to group term life insurance coverage. The need, though, is still the same, but the interest has changed. Since 1980, research firm LIMRA reports that individual life insurance policy sales are down 50%. Now, that decline could be explained possibly by the prevalence of workplace programs. However, the Department of Labor in 2013 refuted that reasoning when they reported that of those workers who have access to an employer-sponsored life insurance program, only 4% have more than 2 years' worth of salary in coverage. And a startling 6 out of 10% have only 1 year's worth of salary in coverage. Stop and think about it. If you happen to pass away and you're the breadwinner, how far is 1 year's worth of salary going to go for your family? Now, one of the reasons why you may not have purchased enough life insurance, if you feel that's the case, is it's a little bit more difficult to appraise than, say, other material assets. Your car, today, an average sedan, mid-sized sedan in the U.S. goes for about $32,000. The median price for a home in the United States this year is just over $300,000. But the economic impact of you possibly losing a loved one, of the breadwinner dying, is a little bit more difficult to assess. And let's face it, the math is a little more morbid. So we're going to spend some time today that you going through a process that might help you actually arrive at that number. Now, how much do you need? Before we get there, I want to draw your attention to page 12 in this book. If you have it open already, take a look at some of the other assets on that page. We're not going to spend a lot of time on those, but I do want to mention one or two quick things. As far as the minimum mandated coverage go for your house, your auto insurance, your homeowner's insurance, etc., those legal requirements in general are not nearly enough. If you don't believe me, take a look at the rule of thumb recommendations by each of those assets. The first one there you have there would be the bodily injury under automobile insurance at $100,000. That's the recommended amount. What would you guess is the minimum? $25,000. Write that down next to that. Now, the aggregate guidance is $300,000. What would you guess is the minimum requirement there? Just $65,000. And for property damage, $50,000 is the guideline. The minimum, $15,000. Now, under the next category there, for uninsured motorists, where experienced adjusters will suggest at least $100,000 or more in coverage, the minimum requirement, $0. It's not even mandated. And so take a look at those and then look at your auto and homeowner's policy. Chances are for a few premium dollars, you could make sure you're covered appropriately. And keep in mind that other insurances such as flood and the uninsured motorist coverage or earthquake insurance are not mandated at all. Those should be reviewed as well. And once appropriate thresholds are met, umbrella insurance can be added to extend coverage beyond those. And so if you'll also take a look at one other thing that's not on this page. And I only mention it because I like to check boxes. And also, it's a critical component of insurance. If you're like me and like to check boxes as well, write down right now, anywhere on the page or on your notes, disability insurance, and then put a box next to it. Your chances of becoming disabled during your lifetime are 3 times greater than actually dying before regular retirement age. Social Security Administration says that there's a 28% chance a man or a woman will experience a disability during their career who's 20 years old today. The likelihood of that is so high that we recommend you have this insurance, if you can afford none other, before anything else. That's the bad news. The good news is here, because of a generous employer benefits program, you're already covered. Your employer will replace 2/3 of your salary if you qualify for long-term disability. So go ahead and check that box. That's one thing on the list that you don't have to do. And so back to life insurance, if you'll take a look at the page over here, those of you who've done your homework already or reviewed this will notice that one approach to figuring out how much life insurance you need would just be to divide your income by the percentage of return you expect your family to get on what you leave behind. And so if just to use an easy number, and there's an example on that page, by the way, 5%, if you thought that your family needed $50,000 in income year over year after you pass away, then it would take $1 million to generate that much money at 5% indefinitely. Now, that's a pretty simple approach if you add your liability, your debts to that. But let me suggest one that's even simpler, and it's my personal favorite. Some time ago, a man asked his wife, this man happens to be my friend, and this story happens to be true. Man said to his wife, "Honey, how much life insurance do you think we ought to have?" Without skipping a beat, she says, "Well, dear, you're the finance major in the family. You come up with the number, but just make sure it's enough, because I want to grieve by a pool." So if a pool is in your estate plan, then let me suggest another simple approach to figuring out how much life insurance you ought to have. And this is a two-step process. And I'm going to ask you to go through it right now. And we're going to take a couple minutes doing it. The first thing I want you to do is to place yourself in one of two categories. The first category would be early to mid-career. And the other category is going to be late career. I'll let you decide which one you're in. If you're in the first category, early to mid-career, multiply your income by 5%. So if you make $60,000, divide. And so, take your income, $60,000, and multiply that by 5. I said 5%, by 5. So that would give you $300,000, correct? Now, if you're in the second category, in the late career, if you're late career, multiply your income by 5%. Sorry if I just confused you. We'll start over there. Late career, multiply your income by 5%. So $60,000, you come up with $300,000. Now, if you're early to mid-career, multiply your income by 10%. So $60,000 would give you $600,000. That's the first step. So write down whatever number you came up with. Take a minute to do that.
Can you say that again?
I'm so sorry. That was just, I said percent again. Thank you. By 10. I keep saying percent, don't you? So take your income, multiply it by 10. Thank you, Shane. I wanted to see if you're paying attention. Diane Sawyer once said that if there's one thing she learned in life, it is this: there's no substitute for paying attention. You get the prize. You do too, Shane. Thank you so much. Did I botch that up enough? Are we clear now? You have a number written down? So if you're late career, you multiplied your income by 5. And if you're early to mid-career, you multiply your income by 10. All right, now, second step is, and if you listened to Shane last week and have done your homework, you'll already know this number. If not, I want to take a minute and have you run through this. Add up all of your debt. This would include mortgage. This could include car loan. This could include credit cards, RC Willey, Rich Uncle loans, all of your debt. And then add that number, when you arrive at it, to the number you wrote down for a multiple of your income. And I'll give you a minute or so to go through that and to sort out what I just said. Just to clarify once again, one approach is what's indicated in the book is dividing by a percentage. Remember, that was just one step. If you wanted enough money to replace your income indefinitely, $50,000, for example, a year, then you'd divide by, say, 5%. And so that was the division by a percent. And you'd come up with $1 million there. This is the other way around, where you just say a multiple of your income. So if you are early to mid-career, you should have come up with, say, okay, if I'm earning $50,000 or say $60,000 a year, then I need 10 times that, and so $600,000. And then if you have $200,000 between all your household debt, add it all together, then you come up with $800,000. And now you've got a great start on estimating how much you should have for life insurance. By the way, those of you who have met with us in the past for a private consultation, which by the way is available to all of you at no cost to any of you, we can run a life insurance needs analysis. We can collect all your information, and we can deliver to you a customized confidential recommendation. Now, once you have that number written down, let me suggest this. If you have, especially if you have young children still at home, apply that number, or at least one similar to it, not just to the breadwinner for his or her life insurance needs, but to the caregiver. I've told my boss, in no uncertain terms, that if my wife passes away suddenly, don't expect to see me around the office anytime soon. Because the last thing I want to do, if the kids just lost their mom, is send them off to daycare. And so this is just personal opinion, but in my case, while our kids are still young, my wife has just as much life insurance as I do. I hope that makes sense. Take a look at that as well. What I'd suggest you do at this point is just remember that the information given to you today and these numbers that we went through are not enough if you don't actually go and acquire the coverage. And so what you need to do is just make a decision today that if the Lord does call you home early, you don't want to leave a legacy of insolvency, but one of financial security for your family. Which, by the way, is the principle that is predicating all of the process in this program. One of simplicity in action. A good friend of mine would tell you this: as you've gone through these steps, and Shane mentioned earlier that we're now on step 5, if you've been through the previous 4 weeks, what we want to encourage you to do is to keep this as simple as possible, to apply a principle, take action, check the box, and then keep moving forward. Delivering this information is easy. It's taking action that's the hard part. We understand, as Dan Clark often reminds us, that information is nice, it can lead to knowledge, but it's emotion that leads to action. So I hope today you've been able to listen with your heads, but also with your hearts. And remember that in the beginning, if you feel discouraged, or if the math doesn't add up, if the numbers don't seem to match, keep going. The Lord will bless you in your efforts to put your financial household in order. And the key to this is just remembering that once you accomplish one thing, even if you need to keep working on another, keep moving forward to the next. If you can come up with a simple system for yourself, like the story told of an immigrant father who got off the boat and became a successful business owner. He had a very simple process. He kept his accounts payable in a shoebox, his accounts receivable on a spindle, and his cash in the cash register. One day his son said to him, "Dad, I don't understand how you run your business this way. How do you even know what your profit is?" "Son," said the business owner, "when I got off that boat, I was wearing I owned nothing but the pants I was wearing. Today, you're an accountant, your sister's an art teacher, your brother's a doctor. I own a house, a car, a good business, and it's all paid for." He said, "Son, add it all up, subtract the pants, there's your profit." The businessman had a system that was so simple, he made it work. We invite you to do the same. Develop a system for yourself, one so simple that you can use it for the rest of your lives. And if you're looking for a few ideas, I have an idea of where you might find some. The ideas in this book are true. They've been tested, they've been tried, and they will get you to where you want to go, financially speaking, and in many other ways. All you need to do is keep moving forward. The great Ralph Waldo Emerson once said, "That which we apply ourselves to do and that which we persist in doing becomes easier for us to do. Not that the nature of the thing itself has changed, but because our power to do it will increase." And so as you apply these principles, and remember one thing, the immigrant father was successful because he got off that boat with an attitude of austerity and a mindset of saving. It's not about the math. It's about the mindset. And I bet many of you have already learned in your lives that managing money has absolutely nothing to do with assets and debts. It has everything to do with attitude and discipline. May the Lord bless you with both. Thank you.